Hello and welcome to the Property Investment Vehicle course. In this module, we'll be talking about real estate investment and provide you with the essentials to invest in your first property. It doesn't matter if you have zero or little knowledge about property investment or if you are already a seasoned investor. By the end of this course, comprising of 16 modules, you'll be equipped with an in-depth understanding on property investment and also to add value to what you already know. Before you start investing in property, you need to have the right mindset. What does having the right mindset even mean? Well, having the right mindset would mean being open-minded, thinking positively, and not whining or complaining after making a decision, and being accountable for the choices you've made. Complaining and whining won't get you anywhere. The market doesn't care about your complaints because the market will always be the market. Over the last couple of years, property prices have skyrocketed at least 30 times, with an average sales price of US $300,000. This may seem impossible to obtain, especially for those who are still in their 9-to-5 job living paycheck after paycheck. So stop complaining as to why you're still an employee because it's probably your own mistake. But if you're a property owner, would you complain on the fact that property prices have skyrocketed 30 times in the last couple of years? I guess not, because you're already generating thousands or maybe even millions with a property's value appreciation. Therefore, we can conclude that investing in ourselves will be one of the great ways of setting the right mindset before playing the real-time investment game in properties. There's no use in learning 1,001 strategies on how to invest in property, yet having the wrong mindset to begin with. If you notice, there are cases where an individual winning a lottery loses his or her riches overnight, and this is due to a poor mindset, where no amount of money can ever solve this. Wouldn't you agree in order to be rich, one must first start to think like one? If you want to reach the peak of greatness in property investment, you must first have a positive mindset. Welcome back. In this module, we will further discuss on the mindset and attitude of a successful property investor. Purchasing property is indeed a very exciting process. Thus, you've got to be excited too, because how can you invest in something that you have absolutely no interest in? This is very important. For example, when you venture into an investment without the feeling of excitement or eagerness, it will reflect on the money earned. What you will achieve will feel a lack of fulfillment, and worse still, it's as if you're being forced to do something that you don't like. Having said that, your positive mindset and attitude must also synchronize with having a strategic plan prior to investing in properties by finding ways to make investment affordable to you. Property investment is a big venture, which gives short to long-term returns. Therefore, with big investments come big monetary need. With the average prices of property escalating to US $300,000, you would require at least $50,000 to kickstart your investment income. Many people who don't even attempt to try will find that generating $50K is impossible to do. Therefore, having a strategy in your decision-making would mean you're increasing your efficiency and effectiveness when it comes to utilizing your resources. And when I say resources, it means resources such as your time, energy, and money. If you're a business owner, manage your prospects by finding ways to increase your sales, plus adding value to your business. Meanwhile, if you are an employer, give 100% in your role and find ways to contribute to the organization as well as improving yourself. These are some of the simple steps to accumulate your capital for your future investment, where it should go hand in hand with your strategic planning as well. This will be further discussed in the coming modules. Remember, you must learn a new way of thinking before you can master the new way to be. Marianne Williamson. Hi, and welcome back. In this module, you'll learn about the 5 fundamental property principles, which is strategy every successful property investor needs to master. The first principle is opportunity versus problems. There are investors who can come up with 100 problems but can't think of a single opportunity. For example, tenants are going to destroy my property, or What if I lose my job and I'm unable to pay back my loan? We know where this is heading. It's true that sometimes there are so many obstacles that it becomes difficult to identify opportunities. However, don't let challenges blur your vision in identifying countless opportunities that are available. As a matter of fact, there are so many opportunities in the market right now. It's enough for several lifetimes. The second principle is to be familiar with the critical success factors, which are your basics and fundamentals of property investment. What do basic and fundamental actually mean? Basics will set the foundation of your understanding and is the general knowledge which you need to understand before moving forward to an advanced level. For example, you need to understand property investment 1.0 before moving to property investment 2.0. Same principle applies here. Fundamentals, on the other hand, are the factors that take you from good to great. The third principle of property investment is to question everything as everything has a reason behind it. Continue asking as you will gain more knowledge. Investing in property has its own risks, and unlike other investment vehicles, a mistake in property investment is very expensive to resolve. It's important to make a correct, well-informed decision every time, especially if you're new to property investment. Welcome back. In the previous module, we introduced 3 out of 5 principles of property investment. We'll continue to discuss the other 2 fundamental principles in this chapter. Now let's discuss the following principle of managing your doubts. It's important to have clarity before starting your investment venture, because without clarity, you won't be able to invest confidently and you'll be filled with uncertainty. In property investment, you need to have a clear purpose on why you are investing in the first place, rather than doing it aimlessly and wasting your time, energy, and resources. The final principle is to build immense and sustainable wealth. To be a successful and strategic property investor, you must have the ultimate goal of building immense and sustainable wealth, because if not, then what's the point? This is not a negative mindset to have, as it promotes a healthy competition amongst investors. However, the only problem associated with this is when greed takes over. That makes investors act irrationally and rash in their decisions. This brings us to the second term, sustainability, which brings balance when investors are in the pursuit of achieving immense wealth. We live in a world of duality, where there's good and there's bad, black and white, night and day. In property investment, we want to build immense wealth, and thus we'll need to be responsible and think sustainability for ourselves and the market at large. Balance is of high importance. Sustainability in the property investment context means that the wealth that we build can be preserved and transcend generations. By being strategic in property investment, you are not only able to build immense wealth, but you're also able to sustain it and make it last for generations. Now that you have understood the correct mindset to practice and the fundamental property principles, you are now ready for the next part, the reason to invest in property. Let's start with the basics. What is property investment? Investing in property means that you purchase a property with the intention of earning an investment return, either through rental income, where you have other people pay your rent every month, or through the capital appreciation of the real estate, or both. A property investment can be long-term or short-term. In the case of flipping, where the property is bought, remodeled, or renovated and sold at a profit over time. Why do we need to invest? Isn't investing in property risky? Well, of course it is, but let me tell you something. Not investing is even riskier. And with the current economic downturn, another problem arises: inflation. The cost of living is increasing, and important daily items are experiencing an even quicker inflation rate. If you don't do something about this, it will eat up your money slowly without you even realizing it. Imagine having only one source of income, that is your 9-to-5 job, for the rest of your life. The speed at which you reach your financial goal will pretty much be stagnant with only one resource of income. If you have only one source of income in today's world, you may not be able to succeed, let alone survive. I do not deny the fact that purchasing a property is scary and the prices of property are way beyond our affordability. But while it behaves the way it wants and likes, let's look into ourselves instead and see what we can do about it. Because if you're not thinking like strategists, you are only going to be victims. Victims do not get rich, they only complain, and they don't think of ways to get out of the situation. So let's be strategists and let's invest. Now it's time to explore the property investment game. Property investment is a game. To some people, likening property investment to a game stirs a negative connotation. There is a huge amount of money involved in this investment, so why are we referring to it as a game? Well, the answer is simple. A lot of investors take it too seriously and forget that investing should also be fun, just like playing a game. Looking at property investment as a sport will be a lot less daunting and fun. Wouldn't you agree that we make more money when we're having fun? Let's look at the key principles in understanding the property investment game. Just like in a game, it's you against yourself. Remember, just like in any game, you are playing against yourself, and most of the time, you are your own worst enemy. In property investment, this principle is important, very much like archery. It is never about the course, the weather conditions, or other participants. It is only focused on you as the archer and how you control your emotions when aiming for your target. Similarly, in property investment, external factors such as the market can behave the way it wants to, and you have zero control over it. Remember, there's always something you can do to make yourself better and how you analyze and control the situation. While sprinters must maximize every muscle movement to improve their speed, marathon runners must maximize these movements for endurance. In a marathon, you need to take on 1 mile at a time where you need to pace yourself to reach the finish line. Sprinting in property investment may get you injured, and it will take a long time to recover. In any game, there needs to be a game plan. The biggest mistake that investors make is to participate in a game without a game plan. What are game plans? This will be later explained in the coming modules about how to start investing, which include the strategies to tackle and win the game. Welcome back to another module of the Property Investment Series. In the previous modules, we have already explored why we need to invest, as well as looking at the whole property investment game. Now let's explore 2 important parameters in property investment, which will be used to assess your real estate investment potential. There are 2 golden tickets to make money from real estate investments, which are expressed through rental yield and capital gains. Before investing in property, firstly, you need to understand the investment parameter. This investment parameter can be divided into 2, which are rental yield and capital gains. The holy grail for property investors is pursuing an area that promises a high yield in terms of a large capital gain, a strong rental return, and low maintenance, as well as management expenses. First and foremost, let's focus on rental yield. A yield is a measurement of future income on investment. It is generally a measurement used by comparing how much cash an asset may produce annually as a percentage of the asset's market value. In the real estate context, yield can be referred to as the rental income of a particular asset, where this can be generated in 2 different ways, by calculating the gross rental yield or the net rental yield. When calculating gross yield, the following formula is applied. Gross yield equals annual rental divided by market value times 100. Example, property value, current market, $325,000. Rental income per month, $1,800. Gross yield equals $1,800 times 12 divided by 325,000 times 10. Your answer is 6.6% yield. Gross yields are more commonly used as it allows you to easily compare properties with different values and rental returns. It can be expressed as the percentage of the property's market value or purchase price. Make sure you compare apples with apples, but as the property market usually fluctuates in nature, it is best to calculate the yield using the market value. However, do bear in mind that gross yields only provide you with a percentage before necessary expenses. Installments, maintenance, and yearly assessment fees are deducted. Now let's move on to net yield. Net yield is calculated as follows. Net yield equals annual rental income minus annual expenses divided by property purchase price times 100. For example, the monthly rental income is $1,500. Monthly maintenance fees $300. Property purchase is $200,000. Net yield equals $1,500 times 12 minus 300 times 12 divided by 200,000 times 100 equals a 7.2% yield. The calculation of net yield is especially useful in determining your financial capacity in property investment. It gives you a clearer picture on your current financial position and whether your investment is sustainable. Technically, net yield produces a better measure when assessing returns as expenses are accounted for. High gross rental yield does not necessarily mean that your rental return will also be high, as gross rental yield does not account for expenses. In this module, we'll cover the topic of capital gain. Capital gain is an increase in the value of a capital asset, investment, or real estate. Over time, that gives it a higher worth than the purchase price. The gain is not realized until the asset is sold. Capital gain may be short-term, 1 year or less, or long-term, more than 1 year, and must be claimed on income taxes. Capital gains may also refer to as a different form of profit received from an asset, which refers to investment income, in the form of cash flow or passive income that arises in relation to real assets such as property, financial assets such as shares or stocks or bonds, and intangible assets. To illustrate this, let us take a real-life example. In 2011, X invested $160,000 for an apartment unit in Area Z. 2 years later, the unit's value has appreciated by at least 100% to $325,000. This means that X's return on investment based on capital gains is $165,000 in the period of 2 years. The main reason behind the asset's value appreciation is due to its fairly limited units in a very strategic location, where the location also seemed to be a hotspot for expatriates. There are several factors that may contribute to an asset's value appreciation. These factors are location, amenities like supermarkets, stores, shopping malls, schools, accessibility, distance from the city center, availability of public transport, future development, future prospects for commercial and governmental development. Calculating rental yields and capital gains, as well as determining the financial implications before investing in real estate, is a must. It can be complicated, especially if you're relatively new in the field. Run and know your numbers, then seek for professional advice before making an important decision. In this module, we'll cover one of the most critical success factors in property investment, which is the property selection and financing your asset. This is an important factor for a strategic and a successful property investor, as it will either make or break you. Believe it or not, 9 out of 10 amateur investors do not make the correct decision in selecting their property, and this leads to poor financing. There are 2 simple steps to consider when selecting your investment assets. Identify your goals, identify your budget. Identify whether you are purchasing the property for your own stay or for investment purposes, where this is generated through rental income or capital gains. The first way is to identify your monthly budget. Only purchase what you can afford, as you would not want your expenses to exceed your cash flow. First, identify your gross income, which is the salary that you receive at the end of every month. For example, you earn $5,000 US per month, and this is your gross income, which is the income you earn without any deductions or expenses. Then identify your net income, which includes the deduction of expenses per month. Let's say your expenses are 20% from your gross income, so it will leave you with a net income of $4,000. Note that banks may assess your loan application based on either your gross or net income. Let's assume that the bank policy grants lending of 30% for property loan commitment based on your gross income. You get $1,500 from your gross salary of $5,000. The same calculation applies for loan assessment based on net income. After identifying your monthly budget, you can now have a rough estimation of what you can afford to invest. In the previous module, we have illustrated how to finance your property selection by identifying your goals, as well as your monthly budget. Next is to identify your transaction budget. Many first-time investors are able to afford a property based on their monthly budget, but they forget to take into account the initial transaction costs, which also includes other legal fees and stamp duties. A general rule to ensure that you're able to pay the initial transaction fees is by saving up and preparing a budget of around 4 to 5% of the property's price. Assuming that your property price is $500,000 US, you would need to prepare at least $20,000 to $25,000. Remember, you would also need an additional $10,000 to $20,000 for other transactional expenses. Next question, landed or high-rise assets? You need to keep in mind the location of the real estate as it determines its accessibility and how close it is to amenities such as supermarkets or schools. Then select your focus. If you are focusing on rental income, a high-rise property will definitely yield the highest revenue. Even though a landed property may cost more, it does not guarantee higher revenue than a high-rise property such as a condominium. One of the factors is because tenants are always searching for convenience, whether there is a parking space, good security system, and accessibility to major highways. If you're looking towards capital gains, a freehold landed property provides better investment as the prices are more resilient to depreciation as there is land attached to it. In this module, we identify the right mortgage for your balance payment. There are a few types of mortgages that you are able to choose from, which can be broken down into 3 categories: standard term loan, flexible mortgages, fixed-term bundled insurance. Firstly, let's look at the standard term loan. This is your plain vanilla mortgage where the interest may vary, or it may also have a fixed rate which depends on the bank's lending rate. Secondly, the flexible mortgage. There are many variations of flexible mortgages available, where it is normally bundled with a current account that allows a few variations for prepayments that could serve as an interest savings function. Last is the fixed-term bundled insurance. The interest rate of this particular mortgage plan is normally fixed throughout the whole course of tenure. Having listed all the mortgage tenure options available, whichever plan that you may choose, try not to take more than a 20-year loan as interest repayment can be big. The shorter your loan course of tenure, the faster you can pay for your investments. What is usually neglected when picking the right mortgage is the bank's representative that is handling your application. Make sure that the person in charge has the following traits: honesty and integrity. They recommend the right solution for you, not the one that pays the highest commission for them. These people will listen to your concerns first before proposing solutions for you and will not over-promise like a normal salesperson would. Well-connected. It allows the person handling your case to build relevant connections with the credit team, valuers, as well as the approval authorities within the workplace. Are investors themselves. Who can better argue your case than a fellow investor who knows exactly how to justify your cases when things get sketchy? In this module, we will cover the steps to start investing. I know you're eager and excited. There are 3 steps to start your property portfolio. The first rule of thumb in property investment is to check your funds. You need to know where you are. You must take an honest inventory of checking your resources. This will give you a rough idea on the amount of cash that you need to have readily available, or how much would you still need in order for you to start your investment. It is vital for you to understand all of the costs involved in acquiring and holding a property, especially if it's your first time investing in one. However, do not make an immediate assumption that you cannot afford to invest. A lot of people make this mistake by giving up even before starting the game. As long as you have a stable and decent pay job and a solid employment history, you shouldn't have a problem obtaining a loan to help you finance your investments. Next is to budget and manage your finances. It's easy to fall into the trap of poor cash flow management as a rookie investor. To be more systematic in tracking your expenses, set up a budget planner or spreadsheet to make things clear. One useful tip to ensure that you manage your finances accordingly is to under-project your income and over-project your expenses to avoid unwanted surprises. Make sure to set your budget planner even before you start looking for a property, as that will go a long way. Lastly, start creating your investment plan. A saying goes, when you fail to plan, you plan to fail, which is very true. A successful wealth creation through property investment demands that you set your personal goals, determine where you want them to end up, how long it'll take, and then formulate a cohesive plan to get there. The plan serves as a structure for you to stay in the game. Your criteria should be focused on the growth or income you are aiming for. Consequently, you need to determine what type of property you need to purchase and invest on in order to meet your income goals. So plan your action and action your plan. There are two success factors to be taken into consideration in order to be a strategic property investor. Firstly are your key stakeholders who play a major role in ensuring that you invest strategically. Stakeholders are people who, in one way or another, have an impact on you as an investor. As a strategic property investor, it is impossible for you to know everything as time and resources are limited. Therefore, you would need a team that will assist you in the game, which comprises of sellers, those looking for property buyers ranging from property developers to owners, buyers, individuals looking to purchase property, lawyers, tasked to safeguard your legal rights and facilitates the transfer of your property, valuers, they work behind the scene to inform the banks of the necessary value of an asset, agents, licensed real estate agents who hold the rights to recruit and register their team and being the intermediary between buyers and sellers. They are the real property experts. There are three important values that a strategic property investor would need to practice, which is sustainability, responsibility, and collaboration. Firstly, what you need to understand is the property investment market is likened to an ecosystem. The decisions that you will make affect the sustainability of the entire market. We know that in property investment, many investors would like to gain as much profit as possible in the shortest period of time. But do not let that blind you in making decisions that will jeopardize the harmony of the system. Therefore, we have to be responsible in our actions while still making profit out of our investments. A lot of people who venture into property investment are usually overcome by greed, fear, and overexcitement. These results in wanting to accumulate as many properties as possible, regardless of what it takes. A harmonious property ecosystem can only be realized if all property investors have a conscious, collaborative effort to invest ethically in order to preserve the future of the property investment market. We should be helping one another to reach the peak of our property investment success. Hi, and welcome back. In this module, we'll cover the perks of property investment. In property investment, leverage is the number one advantage. As explained in the previous modules, you are able to purchase an asset without having to worry about forking out your own money. Instead, you have the privilege to utilize the bank's money for housing loans. You can also leverage other people's expertise in managing your investment risks. For instance, real estate agents are your eyes and ears in the property market, as they are the experts in the field. If you want to be successful in this game, make sure that you have a real estate agent on standby. The next benefit is when selected correctly, property investment can be a hedge against inflation. The key in making money during inflationary crisis is by holding investments that increase in value over time at a rate in excess of the rate of inflation. This may also apply in the case of rental income. Just as the value of property elevates with inflation, the amount tenants pay over time may also increase, making it possible for the investment property to keep pace with the fluctuating prices across the economy. Another advantage of investing in real estate, which is helpful for first-time investors, especially rental property owners, is that there is a possibility for tax deductions. Every year, millions of landlords pay more taxes on their rental income than they have to. Why? Because they fail to acknowledge and take full advantage of all the tax benefits which are readily available for owners of rental property. You are able to write off mortgage interest payments on loans used to acquire or improve the rental property, as well as deducting the interest on credit cards for goods or services used in rental activity. There are three main risks associated with real estate investment. The first risk is property transactions. It can get very complicated, and it takes at least 3 to 4 months to complete the ownership transfer. The amount of legal documentation involved, especially regarding loan matters, must be taken into consideration. It'll take even longer if you're dealing with leasehold properties, as it involves the state's consent. For instance, if you intend to sell your property in June, you should be more than happy that the transaction concludes before December. This may cause problems in cases where you really need to sell the property due to an emergency, such as having business problems, death, or divorce. Having said that, it indicates that property is not a liquid asset, and you won't be able to collect your money in a relatively short period of time. Property can take some time to sell, where the price may fluctuate as it's dependent on the market. This may result in a significant loss in underlying value for the owner, especially during times of economical crisis. Most investors face financial difficulty as they've spent most of their funds on a property investment, but it could not be sold or it was sold at a lower price. Now let's focus on the risks associated with rental property. After purchasing the property, it is possible that you will not be able to rent it out right away. Searching for potential tenants may take some time, and if this is the case, you may have to incur extra costs from mortgage repayments or property maintenance. Realistically speaking, this period may be a struggle due to shortage of income. There will also be times where you need to pay the discrepancies when the rental income is less than the repayment of the mortgage. Oh, and welcome back. We've finally reached the final chapter of the property investment module. I'm sure the previous modules have given you more confidence and equipped you with strategies on how to grow your property investment portfolio. Now, all the information would surely be meaningless if you do not start and act on it. So this module will give you a recap of the previous modules and simple steps for you to take that leap. Let's INVEST. INVEST provides you with a step-to-step guide to kickstart your property portfolio. Firstly, identify your resources and financial capability. The major step before reaching any destination is to know where you are and take honest inventory check on your available resources. As stated in the earlier modules, you will need at least a capital of $50,000 to begin your property journey. A strong income and having financial savings plan is a foundation that will support your ability to finance your property. Next, narrow down your choices. Once you've calculated and accumulated your capital and you've identified the area you love, where you can afford it, now you're just left with the burning question: landed property or high-rise? Bear in mind that different assets have different cash flow prospects, capital gains, as well as borrowing availability. Now it's time for you to visualize your goals after narrowing down your choices, taking into account the attainability of your goals as well as the time frame to get there. Once you've decided to venture into property investment, it's important for you to stay updated and have an objective to work towards. Goals need a time frame, where using a deadline is also what instills a sense of urgency in your journey. For instance, long-term goal: I'd like to own 10 fully paid condominiums upon my retirement in 20 years' time. Short-term goal: I need to buy a landed property, terrace house, by the end of next year. When you're clear with your goals and the timeline to achieve it, it's time for you to estimate your return of investment, or ROI. Your estimated investment returns can be calculated using rental yields or capital gains, dependent on your investment goals, as discussed in the second module. Now it's time for your selection. After you've identified your resources, narrowing down your choices, visualizing your goals clearly, it's time to select your game plan, which incorporates aligning your purchase with investment goals, objectives, and time frame, focusing on rental yields, medium to long-term investment, or capital gains, short-term investment, selecting and securing the right mortgage, standard term loan, flexible mortgages, or fixed term bundled with insurance, but always bear in mind not to take more than a 20-year loan. Last but not least, it's time to take action. This is the very simple and direct step where you will ultimately determine the success of your game plan. Remember, you don't have to be great to start, but you have to start to be great.